I want you to picture a scene. Imagine you are at a crowded party. The music is loud, the champagne is flowing, and everyone is celebrating. In the center of the room, there is a man holding a silver bar. He is the life of the party. People are patting him on the back, telling him how smart he is for buying that bar years ago. The price of silver has just skyrocketed, and he feels like a genius. But then you notice something strange. Quietly, without making a scene, a seasoned-looking man in the corner puts down his drink, walks over to the man with the silver bar, and sells him his entire stack. He takes the cash, walks out the back door, and heads straight to a dusty, overlooked office building down the street where a mining company is headquartered. He buys a stake in the company and sits down to wait. Most people at the party would call him crazy. They would say, "Why leave the party when the music is just getting started? Why sell the asset that is going up to buy a boring company that nobody cares about?" But that man in the corner knows a secret. He knows that the party for the metal is just the appetizer. The main course, the real feast of generational wealth, is about to be served in the mining stocks. He knows that while the crowd is chasing the shiny object, the smart money is chasing the cash flow. And today, I am going to explain exactly why he made that move and why you might want to consider following him out the back door. We are going to dissect one of the most controversial and potentially profitable moves a precious metals investor can make: selling the physical metal to buy the miners. I know for many of you, this sounds like heresy. You have spent years stacking ounces. You love the weight of the metal, you love the security. The idea of trading that physical reality for a paper stock certificate feels wrong. It feels risky. But I am going to show you the math that changes everything. I am going to show you why, in a bull market, the miners don't just match the metal. They act like a rocket booster attached to the metal. We are going to talk about operational leverage, the magic force that turns a 50% gain in silver into a 500% gain in stocks. We are going to talk about the lag effect and why the market is currently mispricing these companies by billions of dollars. And most importantly, we are going to talk about how to do this without getting wiped out by the landmines that litter the mining sector. This is not a video about day trading. This is not a video about gambling. This is a masterclass on capital rotation. It is about knowing when to switch horses in the middle of the race to ensure you cross the finish line first. So if you are sitting on a stack of silver and wondering what's next, or if you are looking at the mining stocks and wondering if they are a trap or a treasure, you need to listen to every word of this. Because the decision you make in this specific window of time could be the difference between making a nice profit and making a fortune. Let's start by addressing the emotional elephant in the room. We get attached to our silver. We treat it like a pet or a family heirloom. We name our stacks. We take pictures of them. This emotional attachment is dangerous. It blinds us to the function of the asset. Silver is a tool. It is a vehicle for preserving and growing purchasing power. If that vehicle gets you to a certain point, and then another vehicle appears that is faster and more efficient for the next leg of the journey, you have to be willing to swap. The veteran trader who sold 80% of his silver didn't do it because he hates silver. He loves silver. He is arguably more bullish on silver than anyone else. That is why he bought the miners. He believes the price of silver is going to stay high or go higher, and he knows that if that happens, the miners are mathematically guaranteed to explode in value. He treats his holdings as two separate buckets, and this is a framework you need to adopt immediately. Bucket 1 is your insurance bucket. This is your core position. This is the metal you hold for the end of the world. This is the metal you hope you never have to sell. It protects you from hyperinflation, currency collapse, and total systemic failure. You do not touch this bucket. You do not gamble with your insurance. Bucket 2 is your speculation bucket. This is the capital you want to grow. This is the money you want to turn into a house, a car, a retirement fund, or a business. This is the bucket we are talking about today. The veteran trader didn't sell his insurance. He sold his speculation. He realized that the risk-reward ratio had shifted. When silver was at 8 $8, the physical metal was the best trade. It had limited downside and huge upside. But when silver hits $50, $70, $90, the calculus changes. The metal has done its job. Now, the baton passes to the companies that dig it out of the ground. Here is the secret sauce: operational leverage. This is the concept that will make you rich if you understand it, and broke if you ignore it. Let's do some simple math. Imagine a mining company. Let's call it Strike Gold Corp. It costs Strike Gold Corp $25 to pull an ounce of silver out of the ground. This is their all-in sustaining cost, AISC. It includes labor, fuel, insurance, permits, everything. Now imagine the price of silver is $30. Strike Gold Corp makes a profit of $5 per ounce. $30 price, $25 cost. Suddenly, a bull market hits. The price of silver goes up to $40. That is a 33% increase in the price of the metal. If you held physical silver, you made 33%. Not bad. But look at Strike Gold Corp. Their cost is still roughly $25, maybe a little higher due to inflation, but let's keep it simple. Their revenue is now $40. Their profit is now $15 per ounce. $40, $25. Do you see what happened? The price of silver went up 33%, but the company's profit went from $5 to $15. That is a 200% increase in profit. The profit tripled while the metal only went up a third. This is leverage. This is why in a raging bull market, mining stocks can go up 5x, 10x, even 20x, while the metal only doubles. The market eventually has to price the stock based on its earnings. If the earnings triple, the stock price should eventually triple or more, as investors get excited and expand the multiple they are willing to pay. But here is the kicker. The market hasn't figured this out yet. This is the lag effect. Right now, as we speak, silver prices have moved up, but the mining stocks are lagging. They are trading as if silver is still at $25 or $30. The analysts who cover these stocks are conservative. They are scared. They use long-term average prices in their models. They don't believe the rally is real. They are waiting for the price to crash back down. This disconnect creates a massive window of opportunity. You can buy these companies today for pennies on the dollar relative to their future cash flow. You are buying a stream of future profits at a discount because the market thinks those profits won't exist. If you believe, as I do, that silver is in a structural bull market and that prices will remain elevated, then buying these stocks is like buying a winning lottery ticket after the numbers have already been drawn, but before the rest of the world has checked their tickets. However, and this is a massive however, the mining sector is a minefield. For every company that strikes it rich, there are 10 that go to zero. It is known as the widowmaker sector for a reason. You cannot just throw a dart at a list of silver stocks and hope for the best. You have to be surgical. You have to avoid the juniors unless you really know what you are doing. The junior miners are the exploration companies. They are the treasure hunters. They own a patch of dirt in Nevada or Mexico or Peru, and they think there is silver there. They drill holes in the ground and hope to hit a vein. These are not businesses. They are science experiments funded by shareholders. They don't have revenue. They burn cash. To keep the lights on, they have to print new shares and sell them. This is called dilution. Dilution is the enemy of wealth. Imagine you own a pizza, you cut it into 8 slices. You own 1 slice. Then the company decides to cut the same pizza into 16 slices, then 32, then 64. Your slice gets smaller and smaller until it is just a crumb. That is what happens in junior mining stocks. They dilute you to death while they chase a dream. The veteran trader in the video didn't buy these lottery tickets. He bought the producers. He bought the companies that have built the mine, poured the concrete, hired the workers, and are actually pulling metal out of the ground today. These companies have cash flow. They have profits. In a high-price environment, they become cash printing machines. They can pay off their debt. They can buy back their own shares, the opposite of dilution. They can pay dividends. When you own a producer in a bull market, time is on your side. Every day the sun rises and the mine operates, they make money. When you own a junior, time is your enemy. Every day that passes without a discovery is a day they burn cash, and get closer to needing another financing round. So the strategy is quality over quantity. Do not try to find the next 100x penny stock. Find the company that will do a solid 5x or 10x because its profits are exploding. Look for companies with free cash flow. This is the money left over after they pay all their bills and capital expenditures. This is the money that belongs to you, the shareholder. There is another layer to this rotation strategy: dividends. Physical silver pays no yield. It sits there. You have to pay to store it. Mining stocks, especially the profitable producers, pay dividends. As their profits explode with the silver price, they often raise their dividends. Imagine buying a stock for $10 that pays a $0.50 dividend, 5% yield. Then silver doubles and their profits triple. They raise the dividend to $1.50. Now you are getting a 15% yield on your original investment. You are getting paid to wait. This income stream creates a floor under the stock price and compounds your returns over time. But let's talk about the risks, because I would be irresponsible if I didn't. The mining industry is hard. It is capital intensive. It is energy intensive. If the price of oil goes to $200 a barrel, the cost to run the mine goes up, eating into those margins we talked about. You have to watch the energy market. You have to watch the cost of labor. Inflation hurts miners on the cost side, even if it helps them on the revenue side. The sweet spot for miners is when metal prices rise faster than energy prices. Then there is jurisdictional risk. You can have the best mine in the world, but if it is in a country where the government decides to nationalize the mine or raise taxes to 90%, or if there is a civil war, your stock goes to zero. You have to know where the mine is. Is it in a mining-friendly jurisdiction like Canada, Australia, or parts of the US? Or is it in a volatile region? The market discounts stocks in risky jurisdictions for a reason. This is why diversification within the mining sector is key. Do not put all your eggs in one mine. Buy a basket of the best producers. Or buy an ETF, exchange-traded fund, that holds the producers like SIL or SILJ. But be careful, because ETFs often hold some junk companies too. Curating your own portfolio of the top 5-10 producers is often the best path if you are willing to do the homework. Now let's zoom out and look at the macro picture again. Why rotate now? Why not wait? Because the market is a forward-looking mechanism. The smart money, the hedge funds, the generalist investors who usually ignore gold and silver, are starting to wake up. They are looking for value. The tech sector is overpriced. The bond market is scary. Real estate is unaffordable. Where can they find growth and value? The resource sector. The resource sector has been starved of capital for a decade. It is unloved, underowned, and undervalued. This is the setup for a mania. When the generalist capital decides to allocate just 1% of their portfolio to mining stocks, it will be like trying to push the water from the Hoover Dam through a garden hose. The sector is too small. The stocks will go vertical. We saw this in the 1970s. We saw this in the early 2000s. The mining stocks had runs where they generated life-changing wealth in a matter of a few years. But you had to be positioned before the crowd arrived. If you wait until your taxi driver is giving you stock tips, you are the liquidity for the pros to exit. The veteran trader sold his silver because he saw the crowd arriving at the metal, but the mining office was still empty. He is front-running the next wave of capital. He is positioning himself where the beta, volatility G leverage, is highest. Let's address the two buckets psychology again, because this is where most people fail. They confuse their buckets. They buy a mining stock thinking it is insurance. It is not. If the stock market crashes, mining stocks will crash too, at least initially. They are equities. They have correlation to the S&P 500 during liquidity events. Physical silver usually holds up better or rebounds faster in a crash. Conversely, people buy physical silver expecting it to make them rich overnight. It usually doesn't. It preserves wealth. It grinds higher. It is the tortoise. The miner is the hare. You need both, but you need them for different reasons. The rotation strategy is about maximizing the speculation bucket. It is about taking the purchasing power you preserved in silver and deploying it into a vehicle that can multiply it. Once you have made that 5x or 10x gain in the miners, what do? You don't hold them forever, you sell them, and you buy back the physical silver or real estate or land. Imagine selling 100 ounces of silver to buy a mining stock. The stock goes up 5x, you sell the stock. Now you have enough cash to buy 500 ounces of silver. You have increased your stack by playing the ratio. You have used the paper market to acquire more real assets. That is the ultimate goal. The goal is not to end up with paper. The goal is to end up with more real wealth. This requires discipline. It requires you to sell when you feel like a genius. It requires you to buy when you feel like an idiot. The veteran trader sold his silver when everyone was cheering for silver. He bought miners when everyone was ignoring them. He is a contrarian. To succeed in this game, you have to be comfortable being uncomfortable. I want to mention uranium for a moment, because the video touched on it. The resource sector is connected. The same thesis of underinvestment applies to energy, copper, uranium, and oil. The world has underinvested in stuff and overinvested in apps. We are entering the revenge of the old economy. The companies that make real things, that dig real stuff, are going to be the leaders of the next decade. The energy crisis is the backdrop for the metals bull market. You cannot have a green energy transition without silver, copper, and lithium. You cannot have AI data centers without massive amounts of power, uranium, gas, and conductivity, silver gold. The physical world is asserting its dominance over the digital world. The mining stocks are the proxy for this physical reality. So, how do you execute this? You don't have to sell 80% like the trader in the video. That is aggressive. Maybe you sell 20%. Maybe you swap your high premium coins for generic bars to free up some cash and put that cash into miners. Maybe you just direct new savings into miners instead of metal for a while. Start by making a watch list. Look at the top silver producers. Look at their balance sheets. Do they have debt? When does it mature? Look at their cost of production. Is it low? Look at their jurisdiction. Is it safe? Then wait for a red day. Mining stocks are volatile. They will drop 5% or 10% on a bad day. That is your entry point. Do not chase green candles, buy the red ones, and set a stop loss. If you are wrong, if the price of silver crashes back to $20, the miners will get crushed. You need a trapdoor. Decide in advance how much you are willing to lose. If this stock drops 20%, I am out. Protect your capital. This is speculation, remember? Speculation requires risk management. Insurance, physical, does not require a stop loss because you are holding it forever. I want you to think about the timeline. This is not a trade for next week. This is a trade for the next 1 to 3 years. The cycle takes time to play out. The lag effect can last for months. You have to be patient. You have to have conviction. If you find yourself checking the stock price every hour, you are over-allocated. You have too much money in the trade. Sell some until you can sleep at night. The best trades are the ones you can ignore because you did the work and you trust the thesis. The transition from stacker to investor is a journey. Stacking is the first step. It teaches you about sound money. It teaches you about saving. But investing is the next level. It teaches you about value creation, leverage, and cycles. The move to mining stocks is a graduation. It is stepping into the arena of the professionals. You're going to be competing with algorithms, hedge funds, and insiders. But you have an advantage. You have a longer time horizon. They have to report quarterly earnings. They have to show short-term performance. You can wait. You can hold through the volatility because you don't answer to a board of directors. You answer to your future self. The veteran trader in the video isn't magic. He isn't psychic. He just understands history. He knows that in every gold and silver mania, the stocks eventually go ballistic. He is positioning himself in front of the train. Are you willing to stand there with him? Are you willing to trade the comfort of the physical bar for the volatility of the paper certificate? It is not for everyone. If you are near retirement or if you have low risk tolerance, stay in the physical. There's no shame in safety. But if you are young or if you want to aggressively grow your wealth, you have to look at the miners. The asymmetry is too good to ignore. The downside is real, but the upside is life-changing. Let's reframe the sale. You are not selling silver. You are renting the stock market to multiply your capital with the intention of buying more silver later. You are taking a detour through the land of leverage to arrive at the destination of greater wealth. The party is still going on. The music is loud. The champagne is popping. But notice who is leaving. Notice who is quietly cashing out their chips and moving to the next table. The smart money moves in silence. The crowd moves in noise. Be the smart money. Do the research. Understand the leverage, and don't be afraid to walk out the back door when the opportunity presents itself. The real party is just getting started down the street, and you have an invitation. This is a pivotal moment in the cycle. The easy money and physical has been made from the lows. The hard money, the big money, is in the rotation. It requires courage. It requires knowledge. But the reward is worth the risk. So, take a look at your stack. Take a look at the charts. Ask yourself, am I a collector or am I a capitalist? If you are a capitalist, the miners are calling your name. I will leave you with this final thought. Wealth is not a static thing. It is energy. It flows. It moves from undervalued assets to overvalued assets and back again. Your job is to follow the flow. Right now, the flow is building pressure behind the dam of the mining sector. When that dam breaks, the flood will be historic. Will you be holding a bucket or a thimble? Position yourself now. Do your due diligence. And remember, the trend is your friend, but the cycle is your master. Respect the cycle and it will reward you. Ignore it and it will crush you. The choice is yours. The sell button is scary, but sometimes it is the most bullish button you can press.